Hey guys, happy sip day.
Happy sip day.
Happy sip.
Sky was looking very jolly today.
Tis the season.
Fa la 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 la. It is the season, although I'm wearing a t-shirt too. So a Santa hat and a t-shirt. I must be in a southern climate, or it's unseasonably warm. But yeah, tis the season for the holidays are coming up, and not always in the holiday season, but there is a tendency for mutual funds to pay capital gains distributions in December. Now, they could pay out at any point in time in the year, depending on that particular mutual fund, but they tend to pay out towards November, December timeframe is a very
Yep.
popular time. So, what is a capital gains distribution?
Yeah, so it is when a mutual fund or a investment pays out distributions from their funds back to shareholders. And because it is a distribution, it is a taxable event. So capital is returned to investors in a few different ways, dividends being the main one that most people are used to. But capital gains is a big part of it because it does not increase the price of the fund itself, but because it's taken from net asset value or NAV, but it does create a tax impact if it's taken received in a taxable account. It's an IRA or Roth IRA or qualified account, then you don't have to worry about that. But in taxable accounts, you do.
Yeah, so throughout the year, a mutual fund manager has investments that they purchase and that they sell, and there's different, changes that they may do based on what the asset allocation of the fund is supposed to be, and sometimes it drifts out of balance, or sometimes there's specific investments that they want to sell and take the gains so that they can place other investments. And when there is a gain for an underlying stock or bond or just whatever that mutual fund is investing in, when they sell it, then the amount of gain that was there has to be distributed to the investors. And when it's distributed, it actually reduces the share value of the mutual fund. So if you have a mutual fund worth $100 and it pays a 10% distribution, then you now have a mutual fund that is worth $90 and you have a capital gains distribution worth $10. So if you have your distributions paid to cash, that's pretty simple. You have $10 and you have $90 worth of mutual fund. But a lot of times, and if you're not taking income from your investments, you would want to have those distributions reinvested so that you can work on a that helps with compounding. So now you have a $90 mutual fund and now you have to invest $10 more into it. So the per share value drops, but your total investment stays the same. So it looks
It's the
like
same.
your
Mhm.
investment hasn't really fluctuated in value, and it hasn't.
Good
But
question
because
though.
that was paid out.
When you do reinvest it, are you delaying the tax event?
No, there's
No,
no
great
delay of the
question.
tax event. It just goes back into the into that fund at that lower share price.
Okay.
And but the $10 in this example would then be taxed. How much would it be taxed? It would be taxed at whatever the shareholders um, tax rate is at the time. And if it's a short-term gain, it gets taxed at ordinary income rates. If it's a longer-term gain, it's taxed at 0, 15, or 20, according to the current tax rates based on the
That's right.
level of income from all sources that the investor has. So kind of if you were thinking about purchasing mutual funds, not in a retirement account, such as an IRA, Roth IRA, 401k, you might consider a capital gains distribution as a reason not to purchase before a capital gains distribution is going to be paid, because it's going to
Right.
result in you having to pay more tax, even though you never even participated in that investment gain
Right.
that the mutual fund had over time. So it can be problematic, and it's
Yep.
something to avoid. And it's also for taxable accounts, it points to maybe using more tax efficient investment options. And when you're analyzing mutual funds, they have something that's called a turnover rate, which kind of shows you how much they buy and sell inside of that fund. So lower turnover rate is going to look better for you. And of course, exchange traded funds don't pay out capital gains distributions based on the way that the creation units work internally. So they're just inherently more tax efficient.
Yeah. And it's a really good point, Sky, in terms of looking at the turnover rate for mutual funds. But what can also happen is if during the year investors have sold out of that position and the fund needs to return capital to shareholders because of liquidations, um, even though the fund might not have turned over their portfolio that much, that can also cause a capital gains distribution. But typically speaking, index funds, even in mutual fund form, pay out less capital gains than an active managed fund. But even further tax efficient, like Skylar was saying, is ETFs because they have creation units. So when a shareholder sells an ETF, they don't have to go out and sell actual shares. They create new units, which causes that tax impact to not be passed on to shareholders, where mutual funds cannot create new share units. So they have to actually sell positions to redeem. So it's quite it's somewhat complicated, but at the end of the day is when you're looking to buy new positions within for mutual funds, check the capital gains distribution date rate, because if you buy it before that date, then you could get hit with capital gains, even though you haven't owned the fund for the full year.
And if you have owned the fund, you may have been purchasing it over a period of time, just incrementally through dollar cost averaging, or you have your reinvestments that have been going into that fund, which creates a different tax lot. And if you are looking at the fund and you see that the capital gains distribution is a certain percentage, like 10%, but your actual gain in that fund is less than 10%, you could sell the fund or you could sell that tax lot,
Right.
pay the tax on the gain that is less than what the distribution is, and you would wind up being better off from a tax situation. So, and this is all dependent upon what your total income is outside of any one mutual fund or any one capital gains distribution. Because if you're married and filing jointly and your taxable income is less than $44,000 or so, you're not paying capital gains tax anyway. So pay me. But anyway, this is something that we like to look at, throughout the year, and especially at this
Yep.
time of year, to try and make sure that we are creating tax efficiency for our clients.
Exactly right.
Thank you for joining us, guys, on today's sip. We will see you next week.
See you next
Bye.
week.